Introduction to Respa. We closed out the last session saying that although the closing table might accommodate many people, not all the stakeholders are present. The federal government also takes an interest in what happens at closing. The federal government wants to make sure that buyers understand the terms of the loans they are undertaking. The federal government also wants to protect buyers from artificially inflated costs associated with the settlement of the sales transaction. A law called the Real Estate Settlement Procedures Act, or Respa, is the mechanism that tries to achieve these two goals. Let's go over that acronym one more time because we'll be using it a lot in this lesson, and you'll hear it a lot out in the wild. It pays to know what the acronym stands for. The title says it all: the Real Estate Settlement Procedures Act. It's a law used in real estate, RE, to regulate settlement procedures, SP, and it's an act of Congress, A. Respa. Where did Respa come from? Well, back in the early 1970s, after lobbying by consumer groups, Congress grew concerned about certain lending practices in the real estate industry. At the time, lenders described their loans to consumers in many ways and included fees and other charges beyond the stated interest rate. As a result, consumers sometimes had difficulty understanding the loans or finding meaningful ways to compare loans offered by different lenders. In addition, some parties involved in the settlement process, title insurers and title searchers, among others, seemed to have special arrangements between themselves and with the lenders for referring business to one another. These arrangements included kickbacks between the parties. For example, if a lender recommended a certain title insurer, the title insurer might charge a higher rate than they normally would for title insurance and send a portion of the overcharge back to the lender in exchange for the referral. As a result, buyers sometimes wound up paying more for services from recommended providers than they would pay for someone else for the same service. Congress wanted to make it easier for consumers to understand and compare loans and to prevent the kickbacks and unearned fees that resulted in higher closing costs. In 1974, Congress enacted Respa to achieve these goals. Congress has amended Respa many times, with the latest amendment coming after the 2008 housing crisis in the 2010 Dodd-Frank Act. What Respa requires. Respa applies to all federally related mortgage loans. As with any complex congressional act, a host of exceptions, exclusions, and special circumstances apply. In general, though, Respa applies to any sale of a 1 to 4 family residence, which includes a loan by a commercial lender. Respa works by requiring lenders and/or mortgage brokers to give buyers a series of strictly timed disclosures about the loan, and by imposing an enforcement scheme to prevent kickbacks and unearned fees. The enforcement scheme includes direct oversight by the Consumer Financial Protection Bureau, CFPB, and indirect oversight through private lawsuits brought by individuals. Respa's beating heart, from the perspective of the buyer, are the disclosure requirements. After a buyer submits a loan application, the lender has 3 days to give the buyer 2 items. The first item is an informational booklet called Your Home Loan Toolkit, a step-by-step guide. The toolkit explains the costs associated with closing the loan. It explains things like title insurance, appraisals, and closing agents. The toolkit also explains how mortgage loans work and helps the buyer understand how to shop for loans and figure out whether a loan will be affordable. Respa suggests that the lender give this booklet to the buyer as early as possible. the lender must provide the booklet within 3 days of receiving the buyer's loan application. The second item the lender must give the buyer is a completed form called a loan estimate, or LE. This 3-page form is highly structured, and every loan estimate has the same sections, laid out in the same order, providing the same kind of information. The only things that change are the names of the parties and the numbers associated with the loan and the sale. This uniformity of appearance makes it easy for a consumer to compare loans and settlement services. The buyer can compare apples to apples and oranges to oranges. What's on the loan estimate? The lender's best good faith estimate of all the terms and costs associated both with the loan and with the closing. The first page identifies the basic terms of the loan amount, the interest rate, the required monthly payment, and any prepayment penalties or balloon payments the buyer would have to pay. The first page also summarizes the total closing costs and indicates how much cash the buyer will need to close. With these basic terms all in one place, a buyer can easily compare loans. The second page of the loan estimate provides the lender's best estimate for the details of the closing costs. These costs listed include all the things we've talked about in previous lessons, and more. Loan origination fees, title search fees, attorney's fees, appraisal costs, title insurance fees, transfer taxes, recording fees, mortgage insurance premiums, you name it. Just in case there's something not listed on the form also includes a line labeled Other. You get the idea. The lender is supposed to provide the buyer with a good faith estimate of every cost the buyer might incur with the purchase. The last page provides additional information about the loan, such as whether a home appraisal will be required, whether the loaner intends to transfer loan services to another entity, whether the lender requires homeowner's insurance, and what happens if the buyer is late on a payment. The last page of the loan estimate also includes a section called Comparisons. This section provides comparisons based on the total loan, not just monthly payments. The comparison section tells the buyer how much interest they will pay and how much of the principal they will have paid off by the end of the 5th year. The comparison section also provides the annual percentage rate, or APR. The APR recalculates the interest rate of the loan, including all the fees associated with the loan, such as loan origination fees or points paid for a discount. A loan with a low interest rate might include high fees that result in the buyers paying more over the life of the loan. The APR allows the buyer to compare loan rates with all the costs included. Finally, the comparisons include a number called total interest percentage, or TIP, which expresses the total amount of interest the buyer will pay over the life of the loan as a percentage of the amount borrowed. For example, if the buyer borrows $100,000 and pays $56,000 in interest over the life of the loan, the total interest percentage, or TIP, would be 56%. The TIP helps borrowers compare loans using the same metrics. Congress intended these disclosure requirements, the buyer's toolkit and the loan estimate, to provide the buyer with the understanding and information they need to shop around for loans and lenders. Because the LE, short for loan estimate, includes a good faith estimate of both the loan terms and the closing costs, the buyer is able to compare all the costs of the loans presented by various lenders and select the lender and the closing that is likely to cost them the least. Congress also intended Respa to prevent kickbacks and unearned fees. However, Congress recognized consumers might benefit from efficiencies when a lender refers consumers to settlement service providers the lender owns, or when the lender and the provider are both owned by another entity. Respa calls these interrelated businesses affiliated business arrangements. Respa allows lenders to refer consumers to affiliated settlement service providers, but only if the lender gives the buyer a disclosure called an affiliated business arrangement disclosure. In this disclosure, the lender explains how the lender is related to the settlement services provider, explains that using the affiliated provider will benefit the lender, explains all the fees the affiliated provider will charge, and, crucially, explains that the buyer does not need to use the provider. The lender cannot require the buyer to use its affiliated settlement service providers. The buyer needs to know they can shop around and use someone else. The lender is permitted to require the buyer to use a specified attorney, credit reporting agency, or appraiser in order to protect the lender's interest. But if the lender is requiring a particular attorney, credit agency, or appraiser, the lender must say so on the Affiliated Business Arrangement Disclosure form. Respa's other big disclosure requirement is the closing disclosure, which the lender must give the buyer at least 3 days before closing. However, the closing disclosure form is so important, we're going to spend the next lesson talking about it in detail.